Hi there, I'm Irk, and this is my channel, Get Irked. In this episode, I'm going to show you the easy way I analyze stocks and how it helps me beat the market. In this episode, I wanted to take a deep dive into stock analysis. In other words, how you decide which company you're going to invest in and how you go about doing it. Thanks to a number of laws that were passed in the 1990s and early 2000s, investors now have access to the information that the private investors used to have access to. So there's a plethora of different kinds of data out there that you can look at and use to be able to analyze stocks. However, having access to this much information is almost more of a curse than it is a blessing, as you'll see a lot of different stock analysts who spend a lot of time diving into the details of a company instead of focusing on the overall macro theme. Before we get too much further in the video, I do want to remind everyone that I am not a professional in the finance industry. However, the techniques I show you in this video are the ones that I use to pick stocks, and I have been able to beat the market for more than 10 years in a row. However, just because these strategies work for me doesn't mean that they're going to work for you. So you'll probably want to consult a professional financial advisor so that you can make sure whatever techniques you want to use for your own investments will work for your timeline and your goals into the future. My approach to picking a company that I want to invest in begins with an overall theme. I need to have a thesis for my investment, and that thesis needs to have at least 3 bullet points, but it doesn't need to have many more than that. The reason I use an investment thesis instead of focusing entirely on a stock's fundamentals or technicals is because I need to be able to know when it's time to get out of a position. Additionally, I don't think it's important to get wrapped up in the balance sheet of a company or all of its cash flow or any of the concepts that you can get wrapped up in if you watch a lot of different stock analyst videos out there. For example, one of my favorite YouTubers is Cameron Stewart, and he's actually a certified financial advisor. And in the video that you're looking at right now, he's going deeply in depth into AT&T with the ticker symbol T. In this 30-minute video, he actually goes through the cash flow, the balance sheet, and everything about AT&T and talks about how undervalued it is as a stock and how it could be a good long-term investment. This video came out on July 23rd, 2020. In July of 2020, even though the market had bounced off the pandemic lows, a lot of stocks were still oversold, so there were a lot of opportunities to be able to get really good investments at that time. And you'd think, with Cameron being a professional in the industry, that this much due diligence would result in AT&T being an excellent long-term investment. As of April 8th, if you had invested in an S&P 500 tracking fund, you would have made over 38% on your investment. So how did you do if you invested in AT&T? AT&T closed the day on April 8th at $24.14. In other words, instead of making 38% in the S&P 500, you'd be down nearly 20% if you'd invested in AT&T, despite the amount of research that went into this particular stock investment. That's an overall difference of 57.977%. In other words, you not only missed out on a 38% gain by investing in AT&T, you were down nearly 20%. Now, this isn't to pick on Cameron Stewart or his analysis. His analysis is very thorough, and he goes deeply in depth in the fundamentals. However, if you did what I did when it came to investing in AT&T, you would have gotten out in 2021. My investment thesis in AT&T was that I wanted exposure to the cellular phone space. I wanted a streaming kicker because AT&T owned Time Warner, which owned HBO, and I wanted a really good dividend, which AT&T had. And in May of 2021, the CEO announced that they'd be selling Time Warner and cutting the dividend, which invalidated my thesis, and I sold immediately on that day. So I got out with just about a 2 to 3% profit, and then sidestepped a more than 30% drop from where I got out of the stock. However, if you'd been looking solely at the fundamentals and didn't have an investment thesis, you would have stayed with AT&T because the stock was undervalued at that point, its balance sheet was still good, and it still had excellent cash flow. But despite all those positive fundamentals, the management of AT&T really screwed up, and the stock sold off dramatically. In other words, there's a lot more to picking the right stock investment than just looking at the fundamentals. So let's go over how I pick a stock investment so you can figure out whether or not those techniques might be better suited for your investment strategies. Peter Lynch, a famous investment advisor, always recommended people start with what they know. It's important to remember that you don't need to make money in every single sector of the stock market. For example, I don't like retail, I don't like restaurants, and I don't like apparel stocks. All three of those sectors depend on fads of consumers, and since consumers are fickle, they can jump back and forth between different kinds of fads, and you can end up in the wrong stock that's down a lot. And that's why I avoid all three of those sectors. When it comes to investing in what you know, I also suggest investing in what you like. You want to be able to be excited about following the stock of the company that you're invested in. You don't want to be bored by the subject matter because you are going to have to do some follow-up to make sure it's doing what you want it to do and that your thesis isn't broken. So like I said, when I develop an investing thesis, I have 3 different bullet points and I try to KISS. Keep it simple, stupid. In other words, I don't want to make too complicated an investing thesis. If I had made my investment thesis too complicated in AT&T, I wouldn't have gotten out when I did, and I would have been down a lot. Now, when Peter Lynch said invest in what you know, it's important to remember that that was just the starting point. In other words, if you really like a company and then you do the research on the stock and find out that it's not a good stock, you shouldn't invest in that company. An example of this is Under Armour. You can really like Under Armour's products. However, the best in breed when it comes to that space is Nike, ticker symbol NKE. Under Armour always underperforms and Nike always outperforms. You shouldn't overthink it. In addition to that, although it is the American way to root for the underdog, that's not the approach that I take when it comes to investing. If there's a best in breed in the space that consistently performs, that's the one I back. It's also important to remember not to get too cute and not to be swayed by a stock's price. For example, if you want to get into the smartphone space, you buy either Apple, ticker symbol AAPL, or Samsung. You do not go down the chain. A lot of investors get tempted by Nokia, ticker symbol NOK, because it has a really low stock price of $5.37. But you have to remember, regardless of how high Nokia may have been in the past, it has a low stock price for a reason. And even though Nokia's been turning around of late, you'll probably be better served if you were an Apple, not Nokia, because the chances that Nokia are going to really improve are very slim, whereas the chances that Apple's going to continue to outperform are very great. Never get swayed by the stock price. Since you can actually buy fractional shares right now, it means that you can buy the best. There's no reason to go down the chain and buy cheap. Buy the best in breed. Don't overthink it. If there is an excellent best in breed in the space, like if you're looking at electric vehicles, you want to buy Tesla. You don't buy Rivian, you don't buy Nikola, you don't go down the chain. Stick with best in breed. If you don't want to start with the idea of an individual company, another approach that I take is to start with a sector that I want exposure to. For example, with all the inflation that the economy is experiencing and the potential that we're headed into a recession, you might want to be in a sector that outperforms during those environments, and one that does this is healthcare and biopharmaceuticals. But when you're talking about a sector like biotech or biopharma, you can have a lot of individual company risk. A company's stock can get cut in half if it doesn't do well in drug trials. So how do you protect against that risk? For sectors like biopharma, where I'd want to have exposure but I don't want the single company risk, instead of buying the best in breed in the space, I'll actually buy a specialty ETF. For example, when you're talking about biotech, you could always buy the iShares Biotechnology ETF with the ticker symbol IBB. Sure, you're not going to perform as well as if you were invested solely in the best in breed in the space. However, you're also going to sidestep any risk should the best in breed have bad drug trials and get cut in half. But let's say you want to invest in a sector and then you found the company that is best in breed in the space. Let's refer back to the example that I said earlier. Let's say you wanted direct exposure to a pure play on electric vehicles or the EV space. There are a large number of different participants in this space now. However, the best in breed remains Tesla, ticker symbol TSLA. So that's the one you should stick with. Now, there's nothing against speculating in some of the other players, but you wouldn't attribute as big an allocation. For example, I do hold shares in Rivian, ticker symbol RIVN. However, it's an incredibly small proportion of my overall portfolio, whereas Tesla gets to have an entire allocation to itself. Risk management to me is more important than almost anything else you do. Once you pick a stock like Tesla, I take a look at it using Yahoo Finance, which you can access just by going to finance.yahoo.com. One of the key figures I like to keep an eye on is the price to earnings ratio, also known as the PE ratio. For a standard stock, a PE ratio of over 20 is considered overvalued, and if you're talking about a growth stock like Tesla, a PE ratio of over 30 is considered overvalued. As you can see, Tesla's PE ratio ratio is 209.24, which means it's extremely overvalued. And another thing that you can use Yahoo Finance for is to check its approach to whether or not a stock is overvalued or undervalued. However, it's important to remember that with a stock like Tesla, there's been no time in its past where it isn't considered overvalued. So if you want exposure to Tesla, you have to get your mind wrapped around the fact that you will be buying it when it is considered overvalued. Now, a lot of analysts probably just cringed at the fact that I'm not going into its balance sheet and I'm not going deep in depth into whether or not it's got a lot of debt or what its cash flow is, because Tesla is the best in breed in the space. However, I also don't just rely on the fundamentals. I also look at the stock on a chart to determine where it is in its range right at the moment that I'm thinking about buying it. There are plenty of ways to get access to the charts. Yahoo Finance even has a little tool that you can use to look at the charts over time. Personally, I use TradingView. TradingView is a robust platform that has both web-based and app-based services that allow you to use charts, fundamental analysis, technicals, and a whole bunch of other stuff. If you're interested, there is a referral link where both of us will get a bit of a kickback if you use it to buy a purchased plan. However, they do have a free plan, and I find that for most people, the free plan is all they need. When you look at Tesla on a chart, you can see that it did have a low in February down here at $700, and it's currently around $1,025.49. With an all-time high up here at $1,243, you can see that it is closer to the all-time high than it is to its recent low. Additionally, if you zoom out on the chart, you can see that Tesla regularly drops significantly over time, so you might want to keep that in mind. This is a very volatile stock. So once I pick an investment, I decide what the allocation size is going to be in my portfolio, and that gives me the amount of money that I want to invest in a stock. So for my typical approach, what I'll do is I'll take that money, divide it in half, and the 50% that I've got will be the initial buy that I do. And then I'll save the remaining 50% to do 5 individual buys, 10% each, as a stock sells off. If the stock never sells off, then I never have a full allocation by buying it. I just let it grow from there. It's a high quality problem if a stock only goes up after you buy it. However, if it does go down, you do want to have money on the sidelines to be able to allocate to it at lower levels if you still believe in it and it hasn't broken your thesis. When it comes to a stock like Tesla, instead of buying 50%, I'll actually only buy 25% initially, because it's possible that it could sell off dramatically from my initial buy. I wouldn't want to make a 50% buy at the $1,000 mark and then have it drop 30% to $700. And yes, Tesla regularly drops that much. In fact, if you look at the drop that it had just going from its all-time high to its recent low, it dropped more than 43%. And this wasn't caused by a pandemic or some sort of black swan event. This was just Tesla selling off with the rest of the market. So you have to keep that in mind. Once I've found a sector and I've found the company I want to invest in, I do a lot of research in terms of what the management does. Referring back to the AT&T example that we were talking about earlier, it is fine if you want to look at the balance sheet and figure out all the different fundamentals that are going on. But here's a thought experiment. The chief financial officer for AT&T made more than $15 million in 2021. When you're talking about playing in the big leagues like that, is it really possible that your average certified financial planner is going to be able to play at that level? Isn't it possible that the CFO knows what he's doing when it comes to the balance sheet? In addition to that, there are probably also hundreds of thousands of other investors combing through the financial data trying to find something. So do you really think you're going to find something that everyone else missed and that's not priced into the stock? It's fine if you want to go into those kind of fundamentals, but for me, it's a complete waste of time. It's like thinking because I used to play hockey when I was a teenager that I can suddenly just go into the NHL and play at their league. Rather than spend too much time analyzing the fundamentals, I'd rather pick the best in breed in the space and figure out what the overall macro trend is for that stock. Even though I'm pretty good at accounting, the chances that I'm going to find something that everybody else in the market missed are slim to none. For me, it's more important to ask myself a number of questions. Does the company I want to invest in have excellent management? How's the company's track record? Does it regularly outperform the estimates when it comes to earnings reports? Does the company regularly produce the best services and products that are available in the sector? And does it regularly innovate? Additionally, when I'm thinking about a company to invest in, I like to think about what the potential pitfalls are. If you're talking about a stock like Tesla or Nvidia, you're looking at stocks stocks that have incredibly powerful CEOs. In Nvidia's case, Jensen Huang is the brains behind the company. If he suddenly got hit by a bus, that would invalidate my investing thesis because he's a big part of leading Nvidia into the future. And the same applies with Tesla and Elon Musk. If you're talking about other stocks like Disney or Nike, their leadership is important, but it's not as vital. Both of those companies have proven over the years that they can hire new CEOs that can lead the company to new higher highs in terms of a stock price. All in all, one of the great things about investing is that it's really personal and it's your own creativity that determines how you put your portfolio together. If you want to spend hours combing through the financial data and looking at 10Qs and 10Ks for earnings reports data and figuring out whether or not the stock works, that's great. You do you. But for me, when it comes to picking an investment, I'm looking at the long term of more than 20 years, and I want to pick a stock that will regularly perform well with great management, great company, and great products and services. After I pick the company, I have my thesis in place, so I know what I'm going to do if I need to get out. That's when I sit down and I do a buying plan, and I approach it very cautiously. To learn more, check out my website, getirk.com, which is always 100% free. Please hit like and subscribe, and I'll see you in the next video.